on the Fed funds rate.
All right, so that's basically some opinion. But we've got Matt Orton live with us now. He's Chief Market Strategist at Raymond James Investment Management. Matt, it's always a pleasure having you with us here on CNBC-TV 18. You've been bullish on India, but it seems like in global markets, we are starting a new chapter even as we wind down this year. Is that so? And this is a risk-off chapter in that sense. From the looks of it, would you agree?
Hey, good morning, Prashant. Great to see you again. And I think we're in a little bit of a blip right now. I think the market is having a collision of two narratives at this point. We've been so one-dimensional throughout the entire year of 2022, really being focused on inflation. Everything that has happened has been related to inflation in one way, shape, or form. And now we're looking at the economic reality and what does that look like? How is it going to materialize going forward, both in the US and around the rest of the world? And I think, like your identity just before me, I think the US economy is going to prove to be more resilient than a lot of people give it credit for. My expectation, we've talked about this in the past, is to see a 5.25% terminal Fed rate, leaving it higher for longer. But because of the tight labor market that we have in the US and the fact that people are still making more money, are still continuing to spend, even though it might be slowing down, that can sustain the overall economy to not see a hard landing. Around the rest of the world, it's going to be more idiosyncratic. It's really going to be country specific. I don't like Europe right now. I think inflation being in double digits is going to take a lot in order to get under control. And there's still a lagged impact of having China closed for so long. But when you look at Latin America, that's been in an area that I've liked for a while. I still selectively like some countries like Mexico, Colombia, Peru. I'm a little bit less bullish on Brazil at this point. And then moving into Asia, I think countries that are tangentially related to China, so call it Vietnam, South Korea, the Philippines, Indonesia, those look interesting along a China reopening story, increased trade. And I do still like India. On a forward multiple, you're trading just around on the Nifty where you were pre-COVID. I think you're going to see margins expand. You're starting to see that play out. And there's some areas of opportunity that I still like within the country. And even though it was such a big outperformer over the past year, I think that can sustain. But my main message to clients, I've been traveling for the past couple of weeks, sharing Outlook with a lot of clients around the country. And the main message, I think this applies everywhere around the world, is we still need to remain defensive. You don't want to chase the market higher. And wherever your allocation is, you want to be leaning into higher quality companies that are throwing off free cash flow. And I think that should guide any investment decisions at least into the middle of next year.
Matt, morning, and thanks so much for joining in. So there is no risk to inflows into India because of China reopening. That's my first question. And the second one is, you spoke about the portfolio needs to be tilted towards defensive stocks, high quality, cash generating companies. Now, in India, the cash generating companies are your technology names, but they have the exposure to the global markets, including Europe, where the outlook is deteriorating. So in that sense, what is the portfolio approach in India?
Yeah, hey, Raymond, it's a great question. And I think India, you've seen India lag over the past month or so as the China reopening story has played out. And you've seen China rally incredibly robustly, as well as Taiwan and some of the other countries that are related to China. But I think that's going to be short term because there's still a lot of uncertainty around China, not just the sustainability of completely reversing the zero COVID policy, but what does government regulation look like going forward? I think there's going to be reticence on the minds of a lot of investors to really being aggressive and moving into China. So I think India can benefit from that once you get some of those initial trades out of the way. And information technology is an area within India that I've liked really for the past quarter or so. And we've talked about it a couple of times in the past. And one of the reasons I like it is because it is exposed to the rest of the world. A lot of the consultancy companies that take and offshore some of the resources that European and U.S. banks and larger corporations need assistance with, that's an area that's going to continue as margins come under pressure and companies have to find ways to be more efficient. And I think you're seeing Indian technology, especially IT services, benefit from that trend. And I would expect that to continue going forward as you see margins come under a little bit more pressure around both the US and Europe.
Hi, Matt. Good morning. Nigel on this side. Matt, the other question I wanted to ask you is, do you believe the Fed will go the distance and walk the talk? They sounded pretty hawkish, but some part, and some opinion that's coming in believes that maybe it's a bit of a bluff and they'll be forced, to go a little easy towards the end of 2023. And that rate cutting that they're talking about in 2024, that may be, preponed a little bit. Your thoughts?
Nigel, I was really surprised by the reaction on Wednesday. I think the reaction we had today was the reaction we should have had on Wednesday, because the fact of the matter is, and the market has gotten this wrong consistently, really throughout the back half of 2022, every time the Fed and Powell has been emphatic in saying rates are going to be higher and they're going to stay there for longer. Somehow there's some dovish interpretation of the message that the Fed gives, and then they come out again and say, we're going to be higher, we're going to be there for longer. And the dot plots once again confirm that. The median dot for 2023 is at 5.1%, and it doesn't have any rate cuts moving in the year for 2023. The market heading into the Fed was priced 50 basis points of cuts in 23 and 200 basis points of cuts in 2024. And to get to that point, you've got to have a very hard landing scenario, and I just don't see it playing out. There's definitely cracks that are forming in the US economy, and that's to be expected as you're unwinding a zero interest rate policy and as the economy is in fact slowing down. But just because it's slowing down doesn't necessarily mean you need to go into recession, and it doesn't mean you need to have a severe drawdown in earnings. And I think what the market has missed is that even with Fed funds at 5.25%, or wherever the terminal rate ends up sitting, a lot of the economy can certainly withstand that. And when we do see recession, my expectation is it's going to be a real recession. You might see a slowdown in real growth, but you're still going to see nominal growth. And it's not going to impact every sector at the same time. And the same thing is going to go for earnings. You're not going to see an earnings drawdown at the same time across the whole economy. And I think that's why you're not going to get the scenario of one big 15, 20% EPS decline, and that can sustain the market or help it move higher into next year.
Matt, thank you very much for joining in. Great conversation. Look forward to chatting with you more often. And in case we don't speak before the end of this year, a Happy New Year. Season's greetings to you.
Thank you. Thanks very much.
Thank you. Time for a quick break. Our list of top 10 stocks is lined up next.